Okay. Well, I wanted to thank Stu for inviting me to address your group. I really admire the fact that you folks are organizing this to sharpen marketing skills, and the timing was perfect because we certainly had plenty of surprises in the March 31st Planning Intentions Report, and even a couple of surprises in the stocks report. This is where Roach customers are concentrated. As you can see, each dot there is 10 subscribers, and so we're concentrated in the Corn Belt and in the Plains, but we have pockets of subscribers all over. This was the quarterly stocks report, and no surprise in the corn, March 1 corn stocks came in at 7.8 billion bushels, and the average trade estimate was 7.8, so the trade nailed that one. Soybeans was a bit of a surprise, came in at 1.531, and the average trade guesstimate was 1.556, so that's a 25 million bushel miss. And since we keep regular track of what the crush is and we know what the exports are, the only conclusion one can reach when a stocks report comes in lower than expected on soybeans is that USDA basically overestimated the size of last year's crop by about 25 million bushels. And so that should help us on the next WSDA report, the next supply-demand report. It should help us draw down those stocks. Wheat was another surprise on the stocks. It came in at 1.327. The trade guess was 1.356. And the wild card in any stocks estimate for wheat is wheat feeding. So this indicated that we fed basically 29 million bushels more wheat than what USDA had calculated in its most recent supply-demand report. Now, here's the biggie. Oh my goodness, I've been in this business for a very long time. My granddaughter calls me a fossil. But 3.6 million acres higher than expected. The trade was expecting 89.9 million acres. That compares to 88 million last year. So the trade was looking for a 1 million acre increase. But what they got was 93.6. 3.6 million acres higher than expectations. And of course the market reaction was instantaneous, a hard down day. The soybean planting intentions came in at 82.2. The trade was expecting about 83. So the soybean acreage estimate was a little bit friendly. It was about 700,000 acres lower than expected. All wheat was a friendly surprise. That came in at 49.6 million acres. The trade was looking for 51.7 million. And there was even a surprise in winter wheat. We thought after the winter wheat seedings report, we thought we had a good handle on that. We should know pretty precisely what the winter wheat is, but it came in at 36.2, which is about 400,000 acres less than what the winter wheat seedings report had told us in December. But the big surprise in wheat was in spring wheat. Spring wheat planting intentions down substantially, 11.3 million acres intended, down from 13.2 a year ago, and the trade was expecting 12.8. So those were the surprises in the planning intentions report. Now, in terms of market reaction, these funds have become very dominant players. I know our producers sometimes get tired of us talking so much about the fund activity going on, but they're like the elephants on the dance floor. And if you don't know what dance they're dancing to, you're going to get squashed. Notice, for example, what happened on March 31st. They sold off, the funds alone sold 40,000 contracts of corn. And that was huge. I mean, I watch this thing every single day when it comes out, and normally a fund move of 10,000 contracts is considered big. But on March 31st, that was such a shocker that they sold off 40,000 contracts. Now what's interesting is look what's happened since though. They hit it really hard the day the report came out, but now they've been buying back. They bought back 4,000 contracts the next day. Didn't do anything on Monday, bought back 6,000 contracts on Tuesday, and another 4,000 contracts today. And by the way, this might not match up perfectly with what you're looking at in your handouts, and that's because I updated this with today's news. But the funds are very important players in the market. And on the soybean side, you'll notice that even though I said that the planting intentions report was kind of friendly for soybeans, And sure enough, the funds bought 4,000 contracts of soybeans on the same day they sold 40,000 bushels of, or 40,000 contracts of corn. But look what they've been doing since then. They bought another 8,000 contracts of beans the next day, but then they sold off 5 on Monday, and they sold off 7 yesterday. And now today, they bought back 5,000 contracts. So those are big, heavy hitters that we have to pay attention to. Over on the wheat side, then the report came out. Sure enough, it was friendly, fewer acres than expected, so they bought 3,000 contracts. Then they didn't do anything the next day. Then they bought back 3,000 more contracts on Monday, but then yesterday they sold 8,000 contracts, turned around and bought 7,000 contracts today. I mean, with the funds involved, it can become a real crapshoot, and it sometimes makes the futures market seem like just a day trader's paradise. Now, here's a state-by-state breakout. This is pretty important for perspective. I want to draw your attention to the big increases, the big percentage increases in corn. Like we know we came up with 3.6 million acres more corn than expected, but few people talked about feed grains as a whole. If you looked at sorghum, oats, and barley, which are also feed grains, combined sorghum, oats, and barley acreage was actually down almost 2 million acres. And in the corn increases, a lot of that came in the South. I mean, you can do the farm boy math in your head. Look at Louisiana, up 330,000 acres at 730. So that's like almost doubling the corn acreage for Louisiana. Then you move over to Mississippi, more than double their corn acreage in intentions. Then you move over into Georgia, very huge increases. Even Texas was up like 14% on corn. But what's interesting is it's been raining to blue blazes in the Delta, and they're not getting their crop planted. Their planting is running way, way behind. And down in the Delta, April 15th is like May 15th here in the Midwest. And what people are speculating now is that they're not going to get that corn planted on time, and they're going to start switching to soybeans. In fact, we think that the June acreage report, when it comes out, will probably show a minimum of 1 million fewer corn acres than what we saw last Thursday, and probably 1 million plus more soybean acres. Here's the soybeans. As you can see, where we had the big increases in corn in the Delta, in the Southeast, what did it come out of? Well, it came out of beans. And what I just told you is what we suspect is that a lot of these acres that showed up Thursday as intended to go into corn may not get planted because the forecast is for continued soggy conditions down there. Looking over into the wheat, the winter wheat plantings and the change, you see minus signs almost everywhere, except in the soft red winter wheat states, and that's where we have increases. And yesterday I would point out that USDA resumed the crop condition reports. They left off in November. Well, they started up again yesterday, and the initial crop condition index for wheat came in way better than anybody expected. We actually showed wheat conditions jumping from where they left off in November, when we've been hearing for the last 6 weeks about how dry it was in Oklahoma and Kansas and the Texas Panhandle, and everybody expected those wheat conditions to be a drop-off from where they left off last November, but instead they jumped to the second highest index reading in the last 5 years. And now the forecast came out today for the plains, increasing the chances of rain where they need it most in the Texas Panhandle, Oklahoma, and Kansas. So all that teamed up to really nail wheat futures today for those of you who grow soft red winter wheat. And by the way, just the soft red winter wheat ratings were very, very high in yesterday's report. Spring wheat was a big surprise, as I said earlier. Big drop in spring wheat plantings, and a lot of those acres were indicated to go into corn as well. And when we get into my balance sheets for corn, what does it mean when we have what we call these, I hate to call them fringe, nobody wants to think of themselves as a fringe corn-producing state, but you know what I'm talking about, outside the Corn Belt, okay? Their yields are lower than what we have in the Corn Belt. And I think the fact that the big increase in corn acreage mostly came in these peripheral states indicates that we can safely plug in a lower yield expectation for the 2016 crop. And I'll get to that a little bit later. I want to draw your attention to the big picture here. Here's the world coarse grain situation. And when you first look at that chart of just steadily rising world coarse grain production, you think, oh my gosh, how are we going to get rid of all that stuff? You look at where we are last year, we were down a little bit, but still at very high levels, but we were lower than the year before and lower than the year before that. Now, here's where you should take some comfort. Yeah, we're producing a lot of coarse grains, but that's the usage side. Global usage is also jumping very dramatically. In fact, if you look at usage, we're off just a little bit from last year's record world coarse grain usage. And so the bottom line is we're no longer in that era where when we have huge crops, we end up with gigantic surpluses that takes us several years to work off, or we have to hope and pray that somebody else has a huge weather problem to get rid of those stocks. We're producing more, but we're using more. Had 6 billion people in 1998-99 using about 850 million tons of feed grains. Now we jumped up to 7 billion people by 2011, and we're using 1.15 billion bushels, or tons, billion tons. Now if you do the farm boy math again, if you do the percentage increase, the percentage increase from 6 billion to 7 billion is a lot smaller than the percentage increase from 850 to 1.1 billion. So not only is the world population rising, but on a per capita basis, we're using more coarse grains because the world is on a protein binge. They want more protein in their diet. Protein means meat, milk, chicken, fish, eggs. What does it take to produce more protein? It takes more feed grains than soybean meal. We've averaged 2.72% average annual growth since 03-04 in world coarse grain usage. Now, this is a table that you might find helpful if you ever wonder, well, I wonder where my sales are compared to the average guy. This chart, the jaggedy line, shows the percentage of the crop. This is a 3-year average, not the current marketing year. We're talking about 2012, 13, 13, 14, and 14, 15. We won't have the numbers for 15, 16 until late this fall. But the zigzag line here shows the percentage of the crop that the average farmer sells month by month. So you start out with about, if you've ever wondered, well, I wonder how much the average guy has sold before harvest. Well, it's about 8% of the crop. On average, about 8% of the crop is priced before harvest begins. Then you jump back up over to here, move over to the scale, about 13% of the crop gets sold in October. Then it tapers off to 12 in November, drops down to about 10% of the crop in December. And then there's a big jump again, the post-tax season sales, where we jump up to about 14% of the crop in January, and then it tapers off through the rest of the year. Now the vertical bars here, that's the cumulative total of sales. So this answers the question, I wonder where the average guy is on his corn sales. We're in April right now. On a 3-year average basis, the average producer is about 75% sold on corn. So that's the value of a chart like this. I'm not saying that you have to be where they are. You want to be a better than average marketer. But it's just a useful gauge, I think. That's one of the most common questions I get from my consulting clients is, well, you know what my sales are, Dan. Where's the average guy right now? Am I running way ahead of average or am I running behind average? This is the kind of chart that helps answer that question. Now, one of the things that we do with the Roach approach, I'm hopeful that most of you out there at some time in your career, you've heard of the greed-fear cycle. That's the human emotion that gets into our marketing decisions. Maybe nobody in that room suffers from this emotional anxiety, but this is the famous greed-fear cycle, where you get a rally in prices, nobody can figure out why, just all of a sudden prices start rising, you get a little optimistic. Then they keep rising, and you start to get excited. Then you start to find out the reasons why corn prices are rising, and you get to the thrill stage. And then they reach up into this point where they're higher than you ever thought they were going to go because of, problems in Argentina, or the dollar is crashing and exports are picking up, whatever the reason, and you get almost euphoric. And about that time, using the system that John Roach uses, he uses a stochastics approach, that it's in the overbought category. Anything above 75 using his system generates a sell signal. And again, nobody out there in that room, I'm sure, would react, but trust me, there are some farmers out say, what? Sell here, come on, it's a raging bull market. John, where are you at? How can you possibly be telling us to sell? And that's because the system is overbought. Then the market goes down, for no reason at all, just stopped going up. You're a little anxious. Do you sell? Nope. Well, maybe you folks would because you're in a marketing club. But the average guy out there said, nah, it's just a correction. It'll come back. It'll come back. But then it keeps going down. You get into a denial stage, then fear, then desperation, then panic. And then just about the time where the typical guy, again, not you folks in that room, but trust me, there are farmers out there who say, daggone it, I blew it again. I might as well just sell and admit it. And about that time, John Roach is giving a buy signal. What? That's because it's dropped below 25. So one of the things that's attracted me to join Roach, but I've known him my entire career, but I really like his system. The system that he uses is mathematical, and it takes the emotion out of the buying and selling decisions. This is the way our sell signals match up. Down here is the system, and it shows where we get overbought. We will issue a sell signal. When it gets down below the 25 line, we issue a buy signal. And so our goal at Roach is to try to help make sure that you're selling the peaks and avoiding the valleys. There will be times, like right here, where we gave a sell signal, and critics might say, well, that was a bad time to sell. It kept right on going up. Does that mean your system was screwed up? No, it just means that it reached the overbought zone, and it just got more and more overbought for several weeks until we got another. Then it broke, then another sell signal here. So the system isn't perfect, but I can explain it very simply. Our job is helping farmers sell grain at price peaks. And that's why we have this as kind of our company motto up here on the top of every single slide. Where are we at? Here, I like to look at a daily chart. I call it daily futures chart as your 5,000-foot view. That's your closest one. And what's interesting is that this was what happened the day that report came out. Just boom, dropped right below these lows. Then the next day we went a little bit lower. But then since then we've been coming back. And you know, these lows here, once they were taken out, they were supposed to become what chartists call overhead resistance. Well, they weren't. We got above them now. So that's why some technicians suggest, well, I wonder if that's a bear trap. Here's the December contract. Did the same thing. December corn was in an overbought stage and we were issuing sell signals. But then it dropped so hard and so fast, it just almost got down into the oversold zone today. It didn't quite get there, just missed it, and then we had an update today, but it's very, very close to being oversold after just a couple of days of trading. Now, the weekly corn chart goes back further back. The weekly corn chart is what I call the 20,000-foot view. So the daily chart's a 5,000-foot view. The weekly chart's a 20,000-foot view. What's it telling us? Well, even with that super bearish planting intentions report, this critical weekly chart support held. That's about 348 on the May corn futures chart. So as long as May stays over 348, we're still in this sideways trading band, even with that bearish acreage report. And what's going on here? Was it not as bearish as people thought? Well, I just told you that everybody talked about the 3 million acres more corn, but nobody talked about the fact that the other feed grains, sorghum, oats, and barley were down 2 million. And nobody talked about the fact that a big part of over 1 million acres was in the south, where they're not getting the stuff planted. Now, what happens? What's the worst case scenario? If corn goes down again in May, the May contract, that's what drives the weekly chart right now. If it drops below 348, man, oh man, there is nothing on this chart until about 320. So this is what I call the died went to hell scenario here. That's your worst case downside risk in December futures is to 320. But so far, it looks like this sideways band is holding. Now the monthly corn chart, that's what I call the 50,000-foot view, because that, as you can see, this goes back to 2009. And we have tough resistance above $4 in the corn, and the first line of support runs at that 348. The worst case scenario on the monthly chart is also down to 320 lows of 2010 and 2014. But look at this. That stochastic system that John uses, you can apply that. It's just a mathematical model. And on a monthly basis, we're way in the oversold zone. So I know you've been trying to tell landlords, perhaps forever, that, you know, gosh, you know, you can't be holding the rents where they are now. Look where corn is. Look how cheap corn is. And the monthly corn chart shows you that based on the new era that we're likely trading in right now, we're at the bottom third of the lower third of the historical price range we're going to see over the next 10 to 15 years. It is cheap, and the stochastic system is telling you how cheap it is. Now, what kind of year are we going to have? Every year at this time, what I like to do is to do the balance sheet, the supply-demand balance sheet under 3 weather scenarios: normal weather, excellent weather, or poor weather. I had to plug in the 93.6 million acres, and some people are using a trend line yield of 168 bushels to the acre, but I'm using 165 here for the reason I told you earlier. A big part of all those extra acres came in the peripheral states where they don't have the kind of yields that we get in the Corn Belt. And that's why I'm putting in a bit, some people are saying, you need to put in 168 there. No, I'm putting in 165. Well, that helps a little bit, and on my algorithm calculates what the usage would be if we produced that big of a crop. But here's the sobering part. Even if we plant that many acres, if we end up planting that many acres, and even if we only have 165 bushels to the acre, we're going to add to carryout. We got 1.8 billion bushels of carryout projected for this season. It's going to go to 2.1 billion under this scenario. So that's one of the reasons that we need to see a shift from corn into something else, because that would then produce a stocks-to-use ratio of 56-day supply, up from a 50-day supply, and an average farm price of about $3.17 a bushel. Versus this is USDA is projecting that the average farm price for the 2015 crop will be about $3.60. So under average weather conditions, we're setting up for possibly having corn prices 40 cents lower than they were a year ago. I don't think you have to worry about this scenario of 171 bushels to the acre because of where we are with El Nino declining. There's a historical basis for when El Nino is in a declining stage. If the ocean goes to cooler than normal temperatures and we go into La Nina conditions, if we get there by fall, can be associated with some crop problems. So what do I think is actually going to be the actual scenario that we have in 2016 is going to be somewhere between this scenario and this scenario. If it would happen to be bad enough weather to knock the U.S. average yield down to 156 bushels to the acre, that's just 9 bushels off my trend line yield, that would be enough to take carryout from 1.8 billion to 1.4 billion and take farm prices to 40 cents higher than you had. So this is your dad went to heaven scenario here, provided that it's some other part of the country that has the weather problems, right? So 40 cents downside risk under average weather, 40 cents upside potential compared to what you're going to average for the 2015 crop if we happen to have some adverse weather. Where are we at now? Which scenario is most likely? That's the next question I get on those 3 weather scenarios. This is the subsoil moisture situation. You can't make the argument, oh, the subsoil moisture is all depleted. It's not. This is where we were a year ago. And if it's white, that's normal. If it's green, it's a little above normal. If it's dark green, that's considerably above normal. So the subsoil moisture situation over most of the corn-producing regions of the country is in better shape than we were a year ago. So if you want to make a case for lower yields, it's not going to come from subsoil moisture. Where are we at in the drought monitor? If all the area that's white means no drought whatsoever. And if it's a little bit yellow, that's just abnormally dry. So we've got some dry areas in the Dakotas, and here's those dry areas in some of the southern plains that we were talking about. But other than that, the drought monitor is not in too bad a shape. Now, what's the weather forecast? What does NOAA say we're going to have? This is the forecast for June. This is the precipitation forecast, below normal precipitation for the month of June in this part of the country. Wherever it's white, that's normal, basically. Normal precipitation for the heart of the Corn Belt, and lower than normal precip for the month of June in the south. Temperature-wise, normal temps. So a good part of the Corn Belt, June is going to be normal precip, normal temps. How about July? Well, July, NOAA currently is saying we're going to have above normal precipitation over the heart of the Corn Belt. That augurs for some pretty decent yields, I would think, if July is above normal rainfall. Temperature-wise, We're going to be normal to just a little bit above normal on the temperature side, so that's good for growing degree days. Then how about the month of August? Now, this is interesting. If they're right, we're going to have a good July, but then things are going to get below normal rainfall through August over the heart of the Corn Belt and warmer than normal temperatures. So depending on what kind of shape the beans are in, August, of course, is the make or break month for soybeans. It could be that we might put some weather premium into the market if this forecast comes true for the month of August. Soybeans. Wow, look at that chart. That's the history of soybean production. And again, don't get alarmed just because this is so high, because look at where the usage is. The usage has been going up even faster. And again, the world is trying to fill that protein gap. What is that gap? What I like to tell people is that if you look at per capita protein consumption from all sources, that's beef, pork, poultry, fish, dairy products, and eggs, in the U.S., we consume about 86 grams per person per day. In Japan, it's about 55 grams per person per day. If you look at that per capita protein consumption in just 3 countries, China, India, and Indonesia, just 3 countries. Doesn't sound like much, except those are whopper countries population-wise. Those 3 countries account for 45% of the world's population. Do you know what the average per capita protein consumption is in those 3 countries? Just 35 grams per person per day. They have to increase their protein consumption by 50% just to get to where the Japanese are. They have to more than double their protein consumption to get to where we are, and now they're finally seeing the per capita growth in incomes. They have the money to buy the stuff. And so that's why we have a very, very good long-term outlook for people who help produce protein. 6 billion people were using 160 million tons in 1998. 7 billion people were using 260 million tons by 2013. And again, do that farm boy math. The percentage increase from 6 to 7 is a lot smaller than the percentage increase from 160 to 260. 4.05% average annual growth rate for soybean usage since 03. Now, here's that same chart I showed you for corn a little bit ago. You want to know where your soybean sales are compared to the average guy over the last 3 years? Go out here to April, move over here to the scale on the right, about 85%. So for the 3 preceding marketing years, the average U.S. farmer was about 85% sold on soybeans by April. And then just creeps slowly upward, held back to that last 15% to see if, we call that gambling stocks, to see if there might be a weather scare happen to move the other 15% at higher prices. Here's the Roach approach. This is how it worked in soybean sales. I'm not going to belabor this, but again, it shows that John's system really works pretty well for catching peaks. That's our whole point. Our whole reason for being is when we give a sell signal and you get a telephone call. That's why I hope you all sign up for a 30-day free trial of our service, because you not only get it in the email, you actually get a telephone call when we have a sell signal. They match up pretty well with catching the peaks, and our buy signals match up when we go below the 25 line. Our buy signals match pretty much with the valleys. So we want to help you guys sell the peaks and avoid the valleys. That's the bottom line. Here's the same approach that I use in soybeans. Plug in that 82.2 million acre figure. Now again, I just told you I think that's going to go up by about 1 million acres by June. But if we just use it for now, 82.2 million acres, a trend line yield, we're going to have a 460 million bushel carryout for this year. Even with average yields, that carryout will likely go up in 2016. The only way we can get it to go down is that if we have enough weather problems somewhere to drop the U.S. average yield by about 3 bushels to the acre, that would drop the carryout to 336 million. And that alone could be producing an average farm price of $10.05 instead of $8.41. May soybeans, the 5,000-foot view. Again, was it a bull trap? We jumped on that planning intentions report because it came in 700,000 acres less than expected, but it was only up for 1 day, and then we were oversold. See down here, we were in the overbought zone, and we were issuing sell signals. and it was down. It was down hard yesterday. It was up a little bit today. Critical support for soybeans in the May contract is at 890. If we do happen to break beans down, 890 hopefully will hold, but if it doesn't, there's potential downside risk to 855, these two lows down here, somewhere between 855 and 860. So the first thing you want to watch if this beans continue to break is, goodness gracious, let's see if 890 holds. Because if it doesn't, then there's probably another 40 cents down. November soybeans, again, the big jump in volatility since Thursday is very obvious. We had fairly tight trading ranges up until Thursday's report came out, and then all of a sudden it was like a yo-yo. And we had a few closes over this high. Again, a bit of a bull trap on soybeans on the new crop as well, because it only traded above that high a couple of days, and now it's dropped back below that line and is definitely in the overbought zone. Weekly soybeans, the 20,000-foot view, sideways. It's been sideways forever, and it seems, in a trade range between 850 and 930, and we're at the top of that trading range right now. We're going to have some type of a weather scare develop to get us over that 930 resistance, and they're clearly in the overbought zone. Monthly soybeans, this is the 50,000-foot view. Now, this is what's interesting. I just showed you on the daily chart and on the weekly chart, we're in the overbought zone, right? But if you look at the big picture, year to year, beans are dirt cheap. We're in the oversold. When you take that same mathematical system and you apply it to a monthly chart that goes all the way back to 2009, it shows that we are definitely oversold. And that's why, even though we're giving sell signals at Roach, we're telling people go easy. What's easy? No more than 20% of the new crop. In other words, we're willing to bet 80% of the new crop on higher prices sometime between now and harvest, but not 100%. You need to get something sold. The Roach wheat supply demand signals, very similar approach, good weather, average weather, poor weather. These prices down here throw people off a little bit because this is for all wheat, which takes spring wheat prices into account. So you've got this sheet in your handouts. If you want to say, well, how does this equate to soft red winter wheat? You want to reduce these prices by about 10%, and that will get you to just the soft red winter wheat equivalent to the overall wheat price. But the important thing to look at is what's going to happen to carryout. We're going to have 966 million bushels of wheat carryout at the end of this year, come May, and if we have average weather, and this is the acreage we end up with, and average yields, we're going to goose that carryout up a little bit to just over 1 billion bushels. Average farm price, though, shouldn't be a whole lot less than what it was for the 2015 crop. If we happen to get into some weather problems, and that would most likely come in the southern plains for hard red winter, and then that dry area of North Dakota had a big drop in spring wheat acreage, and if we start to cook the crop on top of that, we could get a weather scare. And if we could have just enough weather scare to cut the wheat yield from a U.S. average of 45.9 to 42.7, only 3 bushels per acre, look what a big difference in price that can make. That can mean 30 cents higher than last year. And again, on wheat, I don't think you have to worry about this scenario just because of where we are with El Nino, La Nina. So it's going to, what actually happens is going to be somewhere between this balance sheet average and below average. Chicago July wheat, we've got clear overhead resistance at 485, very critical support at 465. If that support would happen to be taken out, then you'd have to go back down to this low right here. And as you can see, wheat is in the overbought zone as well. So that's why we've been having folks sell some wheat in the last day or two. Here's the monthly chart for wheat. Same story as I just told you for beans and corn. Even though the daily charts and even the weekly charts can be overbought, on a long-term basis, this stuff is way too cheap. Using that same mathematical model of stochastics that John uses and applying it, again, same model, same mathematics behind it, it shows that long-term wheat is very, very cheap. And that's why we're telling people you got to sell some wheat, but just a little bit. Don't go overboard on it, because on a historical basis, it's just way too cheap. I mean, if we were looking at $7 wheat, then we'd say, yeah, get 50, 60% sold. But we're not. Here's where we are. So we're saying 15 to 20% tops. For beef producers in the audience, I've got just a few slides on here to show where we are in production forecasts. We're through the first quarter now, and for second quarter, we're expecting some higher beef production, another increase for third quarter, and then dropping off for fourth quarter. Now, what I like to do for folks is I look at where futures are relative to USDA's forecasts. So this purple line down here is actually what the deferred futures contracts are trading. Then I look at what USDA is forecasting for steer prices. They got the high end of their range is the red line, the low end of their range is the blue line, and the midpoint is the green line. And as you can see, actual futures prices are discounted. They're saying, oh my gosh, USDA is way too bullish. USDA's forecasts are just ridiculous. But if you're a cattle producer and you're saying, you think I ought to hedge cattle, looking at this, even if USDA is off, are they going to be off by that much? I'd say not just no, but heck no. You don't want to be hedging cattle after this big break. Their cattle futures are underpriced. Hogs do the same approach. Normally, you know, I'd have a whole bunch of slides on hogs, but I don't know how many people out there are interested in the hog market. I have a lot more information if you are, so just you got my contact info on your handout. Just email me or call me if you want to have more stuff on hogs. Second quarter is what we're in. This is going to be the low point of the year for production. And then for third quarter, we're going to start increasing hog production and then jump substantially in fourth quarter if we follow through with farrowing intentions. But again, there's not any good hedging opportunities in hogs right now. The purple line is where the hog futures are. By the way, you're saying that's not where futures are. To get a cash market, USDA forecasts hogs in cash prices for cash hogs. The futures market is carcass basis. So if you ever want to do a quick conversion, well, what's that current futures price convert to for cash hogs? Just multiply the futures price by 0.74, and that will give you the equivalent. But again, there just aren't any good hedging opportunities in hogs right now. Those of you who buy a lot of soybean meal, however, you might want to be looking at this chart. Soybean meal and soybean oil have been going in opposite directions since last September, and that's because El Nino caused a drop in palm oil production in Asia, and so soybean oil is an alternative, and soybean oil has been going up like crazy while soybean meal has been going down like crazy. The problem with that is we're producing way too much soybean meal. The crushers are crushing beans just for the oil because they're making money on the oil, but we're accumulating big stocks of meal. So this is a buying opportunity for those of you who buy soybean meal. But again, those stocks are out there. You see we were in the oversold zone, and so right back in here we were giving buy signals for soybean meal. That's the end of my presentation. I don't know how much time we have left. If I use up too much time. Minutes.
Anybody have questions for Dan at this juncture? Going once. Go ahead, Brian.
Dan, what's your assumption through all this on the strength of dollar impact over the next year? Anything?
Did you hear that
dollar impact? Was it about the dollar?
How does the strength of the dollar intersect with all of this?
Well, the dollar has been really hurting us because it's so strong. But what's interesting is in the last 8 weeks or so, the U.S. dollar has actually gone into a downtrend. And we really think the stage is set that it could be very well possible that the dollar has peaked. Now, it's not going to collapse. I mean, that would be great for exports if the dollar would suddenly collapse. It's not going to, because we have a situation right now where we stopped printing money like it was monopoly money about a year ago with the fiscal stimulus. The problem is now other countries like Japan and the EU are printing money like it's confetti because they're trying to stimulate their economies. So it's kind of, the dollar is not strong because we suddenly have very, very wise monetary policy. The dollar is strong relative to the fact that the foreign countries have started printing money. But we don't think we're going to go to new highs. We think it's going to be steadily drifting lower, and that's going to be helpful for the export outlook. Another thing that's helping us is that the Brazilian real is actually rising in value because it collapsed and made Brazilian soybeans super cheap abroad about the same time that it was offering Brazilian farmers record prices in their currency. But that has turned around recently, so we have kind of the best of all worlds for our soy export outlook when the dollar's weakening and the real is strengthening.
So in your balance sheet, you have it as a neutral effect then, or what?
Is this neutral at that point?
Yes.
Correct. Any other questions? All right, Dan, we appreciate your time, your contributions here. Thank you, sir, very, very much.
My pleasure.
Everybody knows Kent, and want to hear from Kent on his market position report. So Kent has all the answers.
There it is. Like always, here's a simple review of what we've done, or what old crop, new crop has done since the last time we were here, which was in February. Again, the same thing that we've had for 6 months. Not huge ranges or big movements in that time frame, down to 18 cents. Obviously, a lot of that happened here this last Thursday. But we did have a 31-cent range. From high to low on old crop, basis is still hanging in there because there's still plenty of old crop corn that needs to move. Looking at December corn, we're down 21 cents. Again, a lot of that coming on Thursday, this last Thursday, but we did have a high shortly after the last meeting at 395 December corn, made a low at 364 here at the end of last week, so a 31-cent range there as well. Going to beans quick, old crop is acted up, and we've actually had a 66-cent range, and really for the entire month of March, we saw beans steadily work higher, while corn pretty much sat there and did nothing for the most part until the very end here after this last report. But we also, in beans, have seen basis drop as movement is taking place. A lot of basis has been getting better as well as last harvest, which cuts into some of the gains that you would have seen. But again, that's what we've been preaching all winter. With some of that, we're looking at taking advantage of some of the better basis levels when we could have, and some of the use a while back. New crop beans are up 33 cents. We have a range of almost 70, so we've obviously had some opportunity in here to take advantage of some of that. People have done that. And again, when you look at what corn did in March, basically doing nothing, beans rallying, the corn-bean ratio improving, I think in and of itself has caused some acres that maybe were intended to be planted in corn have already switched to beans. I agree with Dan that there's probably some weather issues in the south that very well could switch some acres there to beans. And we could see the same trend in the corn belt. We just have a long time to go before we're going to see anything switch that already had nitrogen on. We've got a long time to plant corn here. But the market's giving us some opportunity. If you're profitable in here, I would definitely be taking a look at moving some stuff. As far as strategies go, old crop for the most part has been sold. If it's not, I'm just trying to think of guys that I have that don't. Most of them have a base contract with put, but a lot of it has already been moved. Again, at the end of the last meeting, we were looking at trying to get floors in place. If you weren't going to sell it for $3.90 put, you could have bought for about 30 cents, giving you a floor at $3.60. I've got puts anywhere from $3.80 to $4 for the most part. That's about where we've been able to buy anything here this winter. And I also have some sales with some calls for guys that didn't want to buy a put, just get some stuff sold, maybe give yourself a window of opportunity if we were to rally this summer. But what the options have done is, in my mind, exactly what they were supposed to do. They were designed to protect you in case the market would move against you because you weren't willing to sell it, you wanted to wait on some things. Well, we saw some things last Thursday, and now we've got floors that are, in some cases, basically where the market's at, and if we continue to work lower, it pretty much can't hurt you. You're somewhat insulated into that. So, not willing to sell anything, it's a good idea to have floor underneath you, and if you have last Thursday was shock, but at the same now that we know this, at least with corn, in my mind, it all comes down to weather. It's the last bullet you got, in hopes that we get a rally as we've got to have weather issues. But looking at the scenario Dan had up there, my personal opinion is the 93.6 number is probably the highest you're going to see. It probably does come down, but just like you showed, you can come down to 91, and we still got a 2 billion carryout. So we've got to have a weather issue, in my opinion, somewhere along the line. Either here, we could have it in Brazil with their second crop corn. We could have it in China. I mean, there's a lot of places yet that we could have it, but it really boils down to weather. To get the carryout drop low enough to make a substantial difference here on these price ranges. Beans, old crop, again, should have been sold, especially with these rallies that we're seeing. New crop, if it's profitable, I think you should sell. You could look at some call options if you want. But in a lot of cases, guys are, with the market movement higher, are looking at some profits with beans. And I've had several people look at, since the report, at looking at their numbers and figuring out, are they more profitable if they grow beans or corn? And I've got some guys that have switched. If they didn't have an active on, in one scenario, one instance, a guy was going to go from a 40-cent loss that day if he planted corn and got his average yield at that price to a 40-cent profit with beans at that price and an average yield. It swung from a $76 loss to a $22 gain to almost $100 an acre difference. I mean, it was almost a no-brainer to go and do that. But puts are anywhere from 880 to 920 for what I have. But again, I think if you are looking at switching, don't do it and just sit there. You're going to kill yourself, I think, doing that because, again, I think the corn number is probably the highest you're going to see. I think the bean number is probably the lowest, unless the USDA was totally wrong on last week. But if we're switching it to beans, I already think we have enough. So we're going to add to it. It's just adding to the carryout. And I've seen things with average yields working. I think Dan's was about 575 to 600 million carryout. I mean, why do we think these should go up if that was really what we had? So who knows what the August weather will be? Obviously, those pictures up there weather-wise, you got them on your handout show that we could have some weather issues, but unfortunately, we better hope that we have them if we want the market to rally under that scenario. And I pay attention to 2017. I mean, if we're profitable in 16, you might be profitable in 17. If you are, you better be looking at making some sales, getting some stuff locked in, maybe keep some upside, or at least, see what kind of quarter you could give yourself and some upside potential. But I would be looking out there if it were me on beans. If I'm profitable for 16, tonight's 17 price is the same as 16, so I'd be looking at it pretty hard. So I think that was really all I had. There's some questions. I think, maybe we'll have some open discussion, go over some other things, but that was pretty much what I had for my stuff on the positions that we have, where we're at, and what the market's done since the last time we were here.
Any questions? Okay. Thanks, Ken.
Yep.